Hey guys, in this video we're going to talk about how real estate pays you in 4 different ways. 90% of the world's millionaires were created through real estate. And amongst financial specialists, they say that real estate is also the easiest way to grow wealth. And that's because you're getting a return on your money in 4 different ways, and we're going to talk about that right now. So the number one way is what most people think when they think real estate investing, and that's cash flow. And by cash flow, we essentially mean whatever your income is from that property, subtract all of the expenses to include the mortgage, and whatever is remaining is considered cash flow. And quite honestly, when I talk to most of my agents and more of my students, that's what they all want. They want the cash flow because that is what is going to create that passive income for them, or that financial freedom for them to be able to quit their 9-to-5. And many people will stop right there. They're going to look at their return on their investment based on solely the cash flow. And what I mean by rate of return is whatever amount of money that you put into the deal up front is going to be compared to how much cash flow that you get for the entire year. So here's a quick example. Let's say that you put $10,000 down on an investment property. Now, after all is said and done, your cash flow is $200 a month or $2,400 for the year. We'll take that $2,400 relative to the $10,000, and that'll give us a 24% return on our money. That's also called cash on cash return. But it doesn't stop there. There's more. So the number 2 way that you get paid when it comes to real estate is through appreciation. Appreciation just simply means, hey, last year it was worth $100,000 and this year it's worth $150,000 just because the market went that way. Now, I do want to caution you that when you start getting into real estate investing, I'm always a little bit weary of leaning towards appreciation as one of those go or no-go decision makers for whether you should buy a property or not, because depending on where you are and what happens in the market can greatly impact how much the property appreciates or doesn't appreciate. However, it's been reported since 1968 all the way to today that the housing market has appreciated at a rate of anywhere between 4 and 5%, which, like I said before, buy real estate and we wait, it's an easy way to grow wealth. Now, with that being said, we can't really evaluate how much we've appreciated until we either get an appraisal for the property or we actually decide to sell the property and collect the difference of the appraisal value and the amount that we owe on the property. Yet, since we're talking about wealth overall, appreciation does count towards our net worth. And so that is definitely a thumbs up for us. Now, the third way we get paid through real estate is something called depreciation. Really, what that translates to is we get to save more money in taxes. So depreciation is the idea that this building that we own only has so much of a useful life. For investment residential properties, that useful life is 27.5 years. And for commercial investment properties, that useful life is 39 years. So what does the IRS say? They say, hey, whatever you purchased the property for, go ahead and take that amount and then divide it by the useful life. Now, whatever number you come up with, you're able to subtract that from your taxable income every year across the useful life. So here's an example. Let's say you bought a single family rental property for $100,000. Well, the useful lifespan is 27.5 years. So you'll take that $100,000 and you'll divide it by 27.5. This brings you to $3,636 and some change. So what that means is, even if you earned $50,000 or $100,000 that year, you're able to take off an additional $3,636 of your taxable income. Now, I do want to say that this is a simplified model of what this looks like, but this is the concept of depreciation. And finally, the fourth way you get paid with real estate is the principal paydown. When we're talking about the principal paydown, we essentially mean whatever your loan balance is on the property or your mortgage, that's getting paid down incrementally over time. So let's say you went out and you got a loan today. Well, it may start at that $100,000 mark. However, after about 10 years and you go back to reevaluate the loan balance, you might be somewhere around that $75,000 mark. And this is kind of where it gets fun, because now you have a lower loan balance, but the property has probably appreciated over time. And so now that gap between the new appreciation and the new lower loan balance is all of your equity, which we can use that equity for a lot of things, to include getting equity lines of credit, doing cross collateralization where you use that equity and use it as a down payment on another investment property, or just count it towards your net worth. Well, fine, you can just sell it and just take all that money back. But this video isn't really about that. So if you guys are interested in any of those topics, please let me know in the comments below. But let's get back to the loan paydown. Because when you buy a property and it's an investment property, who is actually paying down that principal? It's really the tenant. Whoever is leasing this property from you is paying you something every month. Now, from that money that you make, you're now able to go and pay that mortgage, which brings the payment down. And then whatever's left over, you keep it as the cash flow. So the real beauty of real estate is when you're able to combine all four of those and really get to maximize your return on investment. And how will you calculate that final number? You essentially would add up each one of these impacts individually. And this can be a little bit complicated because when you think about reducing your taxable income amount, really it means how much are you saving in taxes? And because there's different tax brackets, that could be a more complex subject that, again, if you guys want to see that video, please let me know. But overall, you're going to take each one of these impacts, you're going to add them together, and then you're going to divide it by your initial capital investment. So for the sake of simplicity, let's go back to that original example of cash flow, right? Where you put $10,000 in and you actually got $2,400 in cash flow every year. Well, let's say after we add everything up, we're able to double that. We're able to go from $2,400 a year to $4,800 a year. Well, we've also doubled our return. And since it's $4,800, we're going to compare it to that $10,000 initial investment. Well, that's a 48% return on our money, which is huge. And although these are the four ways that real estate will pay you, we're just scratching the surface. Now, I guess I'll leave you with a little bonus. What I love most about real estate is how creative you can be. And honestly, if I had to choose a favorite one of those four, it would be depreciation, because that one can get real creative. So if you guys had to choose a favorite, which one would it be? Let me know in the comments below. I'm always interested to see if people are looking for that cash flow, as most people are when they're chasing financial freedom, or is there something else they're looking for, right? Wealth accumulation through appreciation, or just paying down something slowly over time, like a principal paydown. Let me know in the comments below. But if you found this video useful, then please go ahead and hit that like button and subscribe to the channel if you want to find more videos like this about real estate, about business, and about finance. And as always, thanks for watching, and I'll see you in the next video.